A credit default swap, CDS, is a financial contract that acts like insurance for investors against the risk of a borrower defaulting on their debt. It's widely used in the bond market to manage credit risk, providing protection to lenders or bondholders if the borrower fails to meet their obligations. Here's how it works. In a CDS agreement, one party, the buyer, pays a regular premium to another party, the seller, in exchange for protection against a default by a specific borrower, such as a corporation or government. The borrower in question is known as the reference entity, and the underlying debt, such as a bond or loan, is the reference obligation. If the borrower defaults or experiences a credit event, like bankruptcy or failing to pay interest, the seller compensates the buyer for their loss. For example, imagine an investor holds $1 million worth of bonds issued by a company. Concerned about the company's ability to repay its debt, the investor buys a CDS from a financial institution. The investor agrees to pay $10,000 per year, the premium, for the CDS. If the company defaults, the financial institution compensates the investor for the $1 million loss. If the company doesn't default, the investor only loses the premium payments. CDS contracts are useful for several reasons. First, they allow bondholders to hedge their credit risk. If a bondholder is worried about a borrower's financial stability, a CDS provides a safety net. Second, CDS contracts are used by investors to speculate on a borrower's creditworthiness. For example, if an investor believes a company is likely to default, they might buy a CDS even if they don't own the company's bonds, betting on a payout if the credit event occurs. The price of a CDS, expressed as a spread, e.g., 100 basis points or 1%, reflects the perceived risk of default. A higher spread indicates greater risk. For instance, a CDS on a stable government bond might have a low premium, while one on a high-risk corporation might have a much higher premium. While CDS contracts provide valuable risk management tools, they played a controversial role during the 2008 financial crisis. The widespread use of CDS, especially on mortgage-backed securities, led to massive payouts when defaults surged, putting financial institutions under severe strain. Critics argue that excessive speculation and lack of transparency in the CDS market amplified the crisis. In summary, a credit default swap is a financial instrument that protects against the risk of a borrower defaulting on debt. It allows investors to hedge or speculate on credit risk by paying a premium for protection. While CDS contracts are essential tools in modern finance, they also carry risks that require careful oversight to prevent market instability.